Yeah.
Had a great question at the break, which is about this whole eligible RDTOH, non-eligible RDTOH, GRIP, not GRIP. Ideally, we would like to be able to pay a dividend that would both give us a dividend refund, which would come from RDTOH, right? So it would give the corporation a dividend refund and would also be eligible for the shareholder. The individual shareholder would pay less personal income tax on eligible dividend. So we can only have that situation if we have, well, A, GRIP, that's what makes the dividend eligible, and B, having paid Part 4 tax on an eligible dividend in the first place. So that's a scenario that gives us eligible RDTOH, which is the best thing to have. Eligible RDTOH and GRIP can allow us to pay a dividend, an eligible dividend, and get a dividend refund, thus having our cake and eating it. The important insight is that GRIP comes from two places. It is 72% of our own general rate income. And it also comes from dividends that we receive from other corporations that paid us an eligible dividend. For example, Royal Bank of Canada, if we own shares in a public company, that company would have paid tax on general rate income on all of its income. We would both, in respect of those dividends received from Royal Bank, have received GRIP, plus we would have paid Part 4 tax. That Part 4 tax goes into eligible RDTOH. Someone posted this question. If you want to pay an eligible dividend to a shareholder, but you don't have any eligible RDTOH available, then you can only either pay a non-eligible dividend to the shareholder and receive non-eligible RDTOH, or you can pay an eligible dividend to the shareholder but receive no dividend refund. Honest to God, it gave me a headache, but yeah, that's a correct answer. So it's like one of those double negative, double negative, double negative. The easier way to remember it might be you can only get a dividend refund and have an eligible dividend if you paid Part 4 tax on an eligible dividend. That gave you eligible RDTOH. Hence, if you go back to page 509, which is about the ordering of CCPC dividend distributions. That's the one that gives you, number 2 is eligible dividend to the extent that they refund the eligible RDTOH balance. That's the next best thing to having capital dividends. And that eligible RDTOH balance got filled not from our own GRIP that we earned, 72%, but because we paid Part 4 tax on dividends received out of somebody else's GRIP. Please turn in the textbook to page 428. Please excuse my scroll. So this is a picture of, well, eligible dividends actually. So it's business income earned by a public corporation or by a CCPC on which we couldn't get the small business deduction. So for example, if we had, say, $600,000 worth of active business income, 500 of which, let's assume we have no associated corporations, no large, greater than $10 million taxable capital, etc. So on the first 500,000, we would have this situation. We get the small business deduction, pay only 13% tax, hypothetical, federal, provincial, 9% only, Manitoba. And on $100,000 worth, we would pay high rate tax, general rate tax, and then be able to pay an eligible dividend. Tax on the eligible dividend to the shareholder would only be about 35%. individual shareholder. Amount of double taxation. Because it just doesn't work out perfectly, you recall that the purpose of integration is to tax the combination of shareholder and corporation at the same rate as the shareholder might have paid if the shareholder were an unincorporated proprietor, let's say. It just doesn't work out perfectly. 3% double taxation. Go to the next page, which is 429. Actually, it's worse than 3% in some provinces, including Manitoba. It's as high as an 8.5% extra cost in Newfoundland and Labrador. More importantly for us, it's 4.2% double taxation in Manitoba. Thus, there's a pretty big incentive to not have more than $500,000 worth of active business income. Because when we ultimately pay it out, we'll have paid more tax than if we had earned that money personally, that is, as an individual proprietor. Now, I mean, if we leave the money in the company for a long enough period of time, having been able to invest 73% as opposed to, say, 50% if I took the money, if I earned the money as an individual proprietor and paid 50% tax on it, I'd only have 50% left to invest. But at the end of the day, when I take the money out, I'm overpaying as compared to if I had just taken the money, for example, as a salary and reduced my corporation's income from 600 down to 500. So the question is, what are the rules as regards taking salary out of a corporation? Let's say the corporation earns $2 million. Can we pay a salary of $1.5 million out to the CEO or whomever? And the short answer is probably. Short answer is probably.
It's justifiable. What about Section 67?
What about Section 67? Section 67 is full of the word
Reasonable.
reasonable. So, A, court cases, and B, CRA administrative policy. So if you go to the lecture notes, every once in a while, CRA comes out with a statement of administrative policy on various things. And in this particular one, they are actually restating, not stating, but restating a long-held position on the reasonableness of shareholder manager remuneration. And you'll remember that my example was just now $2 million worth of active business income. And maybe we already paid $250,000 to the CEO as a salary, and we still have $2 million worth of net income even after having done that. And now we would like to pay the CEO, who happens to be the major shareholder, and maybe one or two other senior executives who are also shareholders, $1.5 million. How is this reasonable? Can you discuss the intent of the policy on shareholder manager remuneration? The general policy, or the general purpose, is to provide flexibility to a CECPC and its active shareholder managers, not a shareholder who happens to be a shareholder but that doesn't work in the business. So active, key word here. To take advantage of marginal tax rates, which is page 428. Sorry, this would be a lot better if I actually put it on the screen properly. Thanks to those who've been following along in your computers. It's starting again. Can you discuss the intent of the policy on shareholder manager remuneration? The general purpose is to provide flexibility. That's a word you don't see a lot from a CRA document, by the way. To a CCPC and its active, important shareholder managers to take advantage of, another word you don't see in a CRA document a lot, by reducing the corporation's taxable income to or below the small business deduction limit through the payment of salaries and bonuses from income that is derived from normal business operations. That's also very key. So just as important as active shareholders, also important is normal business operations. And to provide certainty as to the taxable status of the transactions. So what we're about to go through here is what their policy is. This is saying what the intent is. So by the way, it's going to be a good story. The intent is to do something nice for active shareholder managers. So these are shareholders who are actually involved in the corporation, but only to the extent of income that's derived from normal business operations. If we, for example, sold the business this year and have $10 million worth of recapture, that's not part of normal business operations. It might all be active business income because it's recaptured that came from the sale of, for example, a building that was used in the active business, and the capital cost allowance on that building was always a deduction from active business income. That makes the recapture active business income, but that's not part of normal business operations. I'll keep reading. When do you consider a particular situation to be within the intent of the policy? Any straightforward situation where the basic criteria noted above are met, and the income that's used to pay the remuneration was earned from the ongoing, again, normal activities of the business, to be within the intent of the policy. Your corporation makes $2 million of active business income. You want to pay a bonus to the shareholder who's also, for example, the CEO? Tax evasion, tax avoidance, tax planning. Nothing controversial about it. Just please make sure that your person receiving the bonus was in fact active, and hopefully extremely active, and maybe part of the success of the company, not just sort of a junior person. And make sure you're paying it out of normal activities and business operations, not out of recapture and other types of, let's say, abnormal sources of income. Any questions on that? Very powerful, very favorable of CRA to do something like this. Recognition by them of this overtaxation effect, as on page 429, and just planning all day long, nothing controversial about it. It might be the only time in your career that you'll see a favorable, even friendly interpretation by CRA on the word reasonable. Please turn to page 314 in the textbook. Part of the planning that your clients will do for their individual shareholders about making RSP contributions. RSP contributions are a good thing. I've heard of accountants saying, don't make RSP contributions, just retain earnings inside the corporation. But as you know, there is not a full, let's say, tax relief for leaving money in the company. Manitoba is better than every other province. We only pay 9%, therefore we've got sort of 91% money going for us when we invest within the company. But at some point, the amount of investment income will reduce our ability to claim the small business deduction. And plus, we're going to have to pay fairly high rate tax on the dividends when we take them out. So first priority, honestly, is to make RSP contributions. We can only make RSP contributions out of what's called earned income. Earned income is salaries, rents. For our course, though, salaries is really the type of earned income that a shareholder manager gets, that out of which they can make RSP contributions. And there's a limit. The limit for 2019 is 18% of the previous year's earned income to a maximum of $26,500. I did the math for you. That would require having, or when I say that, I mean being able to make a $26,500 RSP contribution means having earned income, i.e. salaries or bonuses, etc., of about $147,000. So, for example, if I'm a shareholder manager, I only have a $50,000 salary so far for the year, I might like to top that up to 147, which would be paying another, I don't know, $97,000 as a bonus. Hopefully that bonus will be out of high rate income in the corporation. But honestly, even if it's out of low rate income, I still might like to have that much earned income to be able to make my full RSP contribution. Any questions on that? Please turn to page 148. Business income is determined on an accrual basis. Does anybody here who didn't study at the ASPA school know what an accrual basis is, what the accrual basis is?
When it's earned, not necessarily received.
I have no better answer than that. When it's earned, not necessarily when it's received. Where'd you study?
Western.
I'll remember that for next time. Income of a business or property is the profit therefrom. You recall that Section 9 says that. The profit is determined on the accrual basis. The accrual basis means when it's earned, even if you didn't actually get it yet in cash. Also means even if you didn't pay it yet, you still get to deduct the expense. I kid you not. So for example, you might say, okay, we're doing the 2019 tax return for the company. The company's year end is December 31st. If what you're saying is true, Dan, then all I have to do is sort of declare this expense as an expense. And I get to deduct it. And let's say that I don't pay it until December of 2020. It's not taxable to the employee until 2020 because remuneration is taxable on a different basis. It's taxable on the cash basis. Please turn the Income Tax Act to Section 5. Income from office or employment, subject to this part 1. Taxpayers' income for a taxation year from an office or employment is the salary, wages, or other remuneration, including gratuities. Oh yeah, sorry about that. Tips, those are taxable. Received by the taxpayer in the year. So, got 2019, and on December 31st, I declare a bonus payable to Dan, payable sometime in 2020. That's a deduction. Let's say it's $1 million. That's a deduction to the corporation in its 2019 taxation year, even though it hasn't been paid yet, because the corporation gets to use this accrual basis. Dan doesn't receive it until December of 2020. Dan doesn't have to pay tax on it until 2020. So we got not only did we beat the situation of double tax or over taxation, we also got a tax deferral. Because the company gets a deduction in 2019, Dan doesn't pay tax until 2020. Income Tax Act says, no, we're going to rein that in. If you declare this bonus, you have to pay it within 180 days of the end of the corporation's taxation year end, which is December 31st. 180 days is sometime in June of 2020. Sometime in June of 2020, and I don't know the exact date. I have to count on my fingers till 31/29. If it's paid in December 2020, as per my facts, the company doesn't get to deduct it in the old year like the company wanted to do. So to summarize, we've got a disconnect here between the accrual basis on which corporations are taxed, which means we get to deduct things when we declare them, not when we pay them. And individuals who are taxed on remuneration on the cash basis, that is when they receive it. We'd like to play that as far as we could, for example, by declaring a bonus in 2019 and paying it in 2020 or 21 or 22 or 23. That would be awesome. Income Tax Act reins that in and says, no, the bonus has to be paid within 180 days, or else the corporation has to refile its tax return for 2019 to not deduct the amount of bonus, the $1 million. Yes?
Is there any penalty or anything like that? You know what I mean? Like, because you could just prepare 2 returns, just hope.
Not really. I don't think there is. I mean, there's interest, obviously, and interest is non-deductible at a fairly high rate, like 5%, compounded daily. But yeah, aside from that.
But you know what I mean? Where it's like if you were just issuing $1 million bonus to duck down to get that to duck under the 500, and then just say, okay, we're issuing it the next year, and if it works out, great. If it doesn't, like, you know what I mean? Like, does it seem like a gamble that may not be, like, if there's no, if you're not losing it, then why would you not just do it and just be like, well, okay, the cost is just 5%. Could you get a loan for $1 million at 5%?
Maybe.
You're right.
This is one of those things that's actually an anti-avoidance rule. And I guess like any anti-avoidance rule, you sort of weigh the pros and cons. But I wouldn't recommend it. I don't think that there's like a series of loans and repayments equivalent here, but it's not something on which I would want to poke the bear because it's an objective rule and not subjective. Objective rules have no comeback if you get reassessed. I haven't thought, maybe there is some type of downside that I haven't thought of, but the only one that comes to my mind right now is interest. Please turn to 78 bracket 4. I'll let you read that at your leisure, and that's where 180 days comes from. Now, there might be other good things coming from this, like for example, if tax rates change between 2019 and 2020, like for example, if personal rates for some reason are expected to decline, much better therefore to push this bonus into 2020 and the individual shareholder, Dan, doesn't have to pay tax on it until 2020 and at a lower rate than 2019. That's awesome. So there might be not just a referral here, but also a rate play. So, as a lawyer, client comes to you and says, setting up a new corporation, give me some advice as to what the year end should be. And I don't know that the year end is actually something that gets enshrined in the constating documents. Like, I don't think it goes into the Articles of Incorporation, for example, but you might be asked for your advice on what the year end should be. And the answer is you might think back, please, to this 180-day rule. And if you say, well, why don't we make it April? If you add 180 days, you're only into October. Thus, there is no possibility of moving income into the next calendar year. Because if a bonus gets declared on April 30th, it has to be paid by sometime in October, 180 days later. Well, that's within the same calendar year. Your individual client doesn't get the potential benefit of moving a bonus into the next, her next taxation year. Thus, it's very common, in fact, extremely common for private corporations to choose a year end of July 31st or later. They're almost always at month ends. You don't want to take June because that doesn't give you enough days to get into the next calendar year, but July 31st does. If you research the year ends of private corporations, my guess is you'd find that many more than 50% of them have a year end of July 31 or later because they got good tax advice at the outset when their corporation got incorporated. Any questions on bonuses, i.e. reasonability, the 180-day rule, Section 5, Section 78. Stock options. Please turn to page 73. Stock option is simply look to help you key employee to buy shares of the company. We will give you the opportunity to buy shares at a discount. It's like Groupon. Is that still a thing, by the way? I haven't been fed a Groupon email for a long time. The trick is the sale price can't be less than today's fair market value. So for example, if shares are trading for $10, the company says, we will let you buy shares for $10 for, say, the next 5 years. Shares go up to $30, you can still buy them for 10. So that's what a stock option is, and it's a good thing, obviously. And there are 3 scenarios. And the one that I want you to know about on page 73 is the one I just described, where it's a stock option of a public company with a designated option price, $10 in my example, that's equal to or greater than the fair market value at the date the option is granted by the employer. So pretend you work for TD Bank, the share price is $10, they say you can get locked in for $10 for the next 5 years. If you want to buy shares, buy them from us and we'll give you shares for $10 even though they're worth $100 at that time.
Just to clarify, that's number 2, right, in that 3 bullet list?
That is correct. Using my example, option price is $10, so that's the amount that we are paying for the shares. And when we exercise the option, the shares are worth $100. So we're able to buy $100 shares for $10. So there must be some taxable aspect to this, and short answer, there sure is. Please go to 7 bracket 1. Where a particular qualifying person, TD Bank, has agreed to sell or issue securities of the TD Bank to an employee, me, if I have acquired securities under this agreement, I have a taxable benefit, which means I have to include in my income. the amount, if any, by which the value of the securities exceeds the total amount paid by me. So I have a taxable benefit of $90, which is kind of as it should be. I mean, I used this coupon to buy a $100 thing for $90. Now, I have a bit of buyer's remorse because I let this go for 4 years and the stock price, went up. I've got this $90 and it's a benefit. It's fully taxable in my income, fully taxable. If I had instead bought the shares for $10 back in the day, all this appreciation would have been potential capital gain appreciation. So I bought the shares for 10, and let's say they're worth 100 now. Let's say I sold them now. I would only be 1/2 taxable.
At probably a lower rate.
Why a lower rate?
Well, isn't capital gains taxed at a different rate than general income?
No, capital gains are taxed at the same rate. It's just that they're only 1/2 taxable.
Oh, okay.
So the Act says, oh, I see your problem. What if we give you a deduction? So include this in your income, but we'll give you a deduction for $45. That would put you in the same place, i.e. net $45 taxable income, as if you had bought them and held them and were taxed only on 1/2 the capital gain. And that's exactly what the Act provides. It provides a 50% deduction. Please go to 110(1)D. So what happens is, in the year we exercise the option, Section 7 bracket 1 says, taxable income for you, employee, $90. And 110(1)D gives us a 1/2, that is $45 deduction against that, putting us more or less in the same place as if we had a capital gain. The only difference, by I mean same place, means 1/2 taxable. But it's not a taxable capital gain, thus I cannot use allowable capital losses against it if I happen to have allowable capital losses or net capital losses. So it's a 1/2 taxable amount, being the full up 90 minus the 45 deduction gives us 45 net taxable amount in the employee's hands. And the corporation, TD Bank in this case, no deduction. Nor should it have, because it actually didn't outlay any cash or pay for anything. This is how stock options work. They're just another alternative way of remunerating employees and shareholders. Thank you for your patience. Please come back at 10 after 3.
No.
I'm just gonna say,
Just in case.
Question, not on this question, more of a general tax question. So I interviewed with the tax from Canada tomorrow, and do you know anything about the Cowthorne case? It's like a guard.
not one.
Okay, I was just gonna ask you something about the way, I can explain the specifics of it. I'm just confused by something about the amalgamation. So basically it's a case where like something happens, there's the corporation, first to do it.
All
There's a new
he said-
legislation, so
all
they
he
want
said
to
is,
do,
I don't know
they
whether
want
I
to make
studied
what is an
what I said.
effective vertical amalgamation look like a
Or whether
horizontal.
I did not
Yep.
intend to specific words.
Oh, we're recording.